Want to start trading? Most beginners blow up in year one. Here's the 12-week roadmap that works.
Here's the number that should slow you down before you open your first trading account. Between 70 and 85% of retail traders lose money. That's not a marketing line. That's ESMA's own regulator-mandated disclosure across European brokers. So the question isn't whether trading is hard. The question is what specifically separates the small minority who don't blow up from everyone else. And the answer, almost every time, comes down to 4 decisions you make before you've placed a single trade. 4 decisions: asset class, broker, strategy, position size. That's the sequence we're working through. By the end, you'll have a 12-week roadmap with specific numbers: risk per trade, starting capital, how long to spend in demo, how many trades to journal before you touch anything. The structure works. Most beginners skip it. Start with the math nobody wants to look at. Lose 10% of your account, you need an 11% gain to break even. Reasonable. Lose 25%, you need 33% to come back. Lose 50%, and this is where it gets ugly. You need a 100% gain. You have to double the account just to stand still. Lose 75%, and the recovery is 300%. The deeper you go, the math turns against you exponentially. This is why position sizing is the entire game, not the entry, not the strategy. Sizing. Because if you risk 5% per trade and lose 6 in a row, statistically normal, you're already 26% down and grinding uphill. Risk 1%, the same losing streak costs you 6%. Same trades, completely different recovery problem. But before you can size anything, you have to choose what you're sizing on. Decision 1. Asset class. And this is the call that quietly stacks the deck against you before you've placed a single trade. Most beginners walk in and go straight to Forex or CFDs because the leverage is exciting. EU and UK retail Forex CFDs let you trade it up to 30 to 1. Sounds like more buying power. It's actually more drawdown speed. The cleanest starting point is stocks and ETFs in a cash account. Zero leverage. No pattern day trader rule unless you're trading US margin above $25,000 in equity. Tax treatment is straightforward, and every lesson you learn, reading a chart, setting a stop, sizing a position, translates cleanly to other instruments later. Crypto spot works mechanically, but the volatility is brutal for a first year. Futures and options have real learning curves. Forex CFDs are where most of those 70 to 85% loss statistics come from. Start where the leverage can't kill you while you're still figuring out where your hands go. Decision 2. The broker. And the only thing that genuinely matters here is regulation, specifically Tier 1 regulation. The FCA in the UK, ASIC in Australia, SCI in the EU, BaFin in Germany, SEC and FINRA in the US, NFA and CFTC for US futures and Forex, MAS in Singapore, SFC in Hong Kong. Why does this matter so much? Because Tier 1 regulators force client money segregation. Your deposit is legally separated from the broker's operating capital. If the broker collapses, your money is supposed to come back. An offshore broker registered in St. Vincent or the Marshall Islands or Vanuatu, you have no equivalent protection. Verify the license on the regulator's public register, not the broker's marketing page. In Europe, eToro, XTB, IG, Trade Republic, Saxo. In the US, Charles Schwab, Fidelity, Interactive Brokers, Robinhood. Beyond regulation, check total costs, commissions, spreads, FX conversion, withdrawal fees, inactivity fees. One low number doesn't mean a low total. Read the full schedule. Asset class chosen? Broker open, now 4 to 6 weeks in the demo account. And here's the trap. Demo trading does not teach discipline. It cannot. The money isn't real, so your psychology doesn't engage. Demo is for one thing, making platform mechanics reflexive. Because the way live accounts get destroyed in the first hour isn't bad analysis. It's clicking sell when you meant close, shorting when you meant to flatten along. Spend 4 to 6 weeks placing real orders, setting real stops, running real exits, until the platform stops being a thing you think about. Same time as demo, you're writing the strategy. 1 page, 6 questions. What instrument am I trading? What time frame? What setup triggers an entry? Where exactly does the trade go in? Where is the stop and how is the size calculated? Where is the target? If you can't answer all 6 for a planned trade, the trade does not happen. That single rule kills more bad trades than any indicator ever will. A common starter setup. A pullback to the 20-day exponential moving average in a daily uptrend, entry on the next day's high break, stop just below the pullback low, target at the prior swing high or a trailing stop. The specific setup matters less than the discipline of having specifics. Vague rules produce vague results. Now you fund the account, $500 to $2,000. Money you can lose without it affecting your life. Less than that, the trades don't feel real. More than that, fear takes over and you stop pulling the trigger on valid setups. Then sizing. Risk 0.5 to 1% of equity per trade for the first 50 trades. On a $1,000 account, that's $5 to $10 of risk per trade. Sounds tiny. That's the point. Most beginners blow up in the first 20 trades by risking too much. And the fix isn't a better entry, it's smaller size. For every trade in the first 100, you journal setup, entry, stop, target, size, exit, profit or loss in dollars and in R multiples, R being your planned risk, plus a one-line note. Did you follow the plan or did you deviate? After 50 trades, the journal starts showing you patterns the screen never could. Which setup actually has expectancy? Which time of day you make mistakes? The journal is the difference between a year of trading and a year of repeating the same week 52 times. And know what you're up against. The accounts that survive year one do the same things. One asset class, one time frame, one setup. Fixed percent risk, daily learning, weekly review. The accounts that die do the opposite. High leverage on the first 100 trades. Sizing by feeling instead of by stop distance. Switching strategies after every loss. Adding to losing positions with no written rule. Trading news on day one. Every one of those is a fast track into the 70 to 85%. One more filter. Skip the paid Discord rooms promising signals. Skip the prop firm gurus selling funded accounts. Skip the millionaire trader YouTube channels with rented Lamborghinis. The genuinely useful material is mostly free. Van Tharp on position sizing. Schwager's Market Wizards interviews. Yale's free Coursera finance course with Robert Schiller. MIT's open courseware. The broker education centers themselves, eToro, Pepperstone, IC Markets, publish real material at no cost. So here's the 12-week roadmap. Weeks 1 and 2, demo open, 2 of those books read, broker education videos watched. Weeks 3 and 4, pick one setup, take 20 demo trades, log them. Weeks 5 and 6, fund the live account, $500 to $2,000. Trade at 0.5% risk per trade. Weeks 7 through 12, your first 50 live trades. Same setup, same sizing. Journal every one. Do not change the strategy midstream. That's the single biggest mistake. End of week 12, you sit down with the journal and calculate 4 numbers. Win rate, average R, total R, biggest losing trade. That's where you decide whether to continue, refine, or walk away. And remember the decision I flagged at the start? The one that quietly stacks the deck. That's the asset class. Stocks and ETFs in a cash account isn't glamorous. It's the option that gives you runway to learn before leverage decides for you. The first year is tuition. Plan accordingly. The goal isn't to make money in year one. It's to finish year one with capital still in the account and a journal that proves your method has an edge.
Stocks and ETFs, cash account, 0.5% risk. Full breakdown linked in the description.